Thank you guys for joining in. I have a great topic for you today. This was a great question that came in from Miss Cardone. Miss Cardone, you know who you are. And the question is, how do I raise money? How do I finance my business as a welcome to the channel. Hey, for those who may be new to this channel, my name is Curtis A. Merriweather Jr. In 2020, I was named a game changer by the White House, by the policy advisor for entrepreneurship and innovation. And I want to serve as your government contracting coach going forward. Now, on this channel, our goal is to help entrepreneurs overcome common business challenges. And most of my subscribers are government contractors by providing consultation, education, and training support. Now, our channel is unlike the competitors' channels because we have made investments in doctoral education. I'll have my PhD in business management in 2023, and it's based on 26 years of uh, progressive business experience. Many of you know I started government contracting at 17, so I've been in this space for quite some time. And one of the things we want to do on this channel is distill and demystify the process for you. There's a lot of misinformation regarding government contracting on YouTube and the social media platforms. So our goal, our desire is to become a safe space where you can trust the information that we're going to present because it's based on practical, theoretical, just real world experience. We've been in the trenches. We don't make our money from selling classes, even though we do have some classes you can buy. We are tried, proven, and tested in this space. So we are not going to tell you things that are going to increase course sales. We're going to tell you the actionable truth. And if you decide you want to partner with me in that process, great. If not, just keep tuning in for a bunch of free content. And thank you for subscribing. So before I jump into what we want to talk about today, I want to make sure that you subscribe to the channel, you like, you share, leave me a comment. I love getting your comments. Matter of fact, today's topic came from a question that I received. So I made a video. It was a great question. I made a video that was going to not only answer that person's question, but I think will serve the broader community at large. Now, for those who may know, we do have a website called 8-Figure GovCon. I encourage you to go in there and take a look at our course library. There's a lot of goodies there. We've also set up a payment plan for the Mastery 5X Mastery system. That's the entire government contracting curriculum. You can go there, and the coupon code will expire on January 31st at 11:59 p.m. Eastern Standard Time, but it will give you a 20% discount if you take advantage before the expiration date. Now that we have that out the way, thank you guys for joining in. I have a great topic for you today. And this was a great question that came in from Miss Cardone. Miss Cardone, you know who you are. And the question is, how do I raise money? How do I finance my business as a government contractor? Now, the things that I'm going to talk about today can just be applied to the global business community. But I'm going to talk about some nuance that's very applicable to the government contracting world. We want to get into this. I have about 6 strategies for you to be able to finance your government contracting business, no matter where you may be, if you're brand new or if you're seasoned, how to raise capital, how to finance that government contracting business, not only to obtain money, but to use that money to grow. So that's what we're going to talk about today. Now, let's get ready to jump into our topic. Now, before I even jump into this, I have to talk about being bankable. So there's this notion versus being bankable versus being non-bankable. Now, bankable means you're in a position where the bank can actually lend you money, and you're deemed to not be a risk. You can even say a flight risk. The bank is in the business of lending money in as risk less as possible. They want to make sure that the money they lend, they're actually going to get a return on that investment via interest and on-time payments. So let me talk about why some businesses are unbankable or non-bankable, meaning they're not quite ready to get financing from a traditional or conventional source like a major bank or a regional bank or a small bank. Number one, it may be that you have limited business history. Could be that you're not profitable yet. We know trends tell us that most businesses take 3 to 5 years to get profitable. So you could be making money, but you're not profitable. So that would be deemed a risk for the bank. Now, it's not to say that you won't have a bad season or a bad year here and there, but for the majority, you should be moving quickly and aggressively toward profitability as a business. Number three, you may have no accounting system. I see this with a lot of newer companies. They don't have an accounting system, and the financials that they do have been unreviewed by a CPA. Newsflash, let me tell you something. The bank doesn't trust your numbers. They don't trust your numbers no matter how great your accounting system may be and how competent your accounting professionals, your CPA, your controller, your CFO. They want to see some financials that have been at least compilation, which is the lowest level of a review, reviewed or audited. Audited financials are the grand standard. This gives the bank some feelings of, this gives you credibility in terms of your numbers. So it gives the bank more comfort knowing that a third party came in and at least did with a compilation of the financials, a review of the financials, or a full-blown audit of the financials. It makes the bank feel warm and cozy that you are doing everything you need to be doing as a business owner to better represent your firm, not only to the world, but also to the banking institutions who may be interested in partnering with you. The banking relationship is a partnership. And then another reason why you may be unbankable. Now, this doesn't mean you can't get a personal loan or a signature loan. I'm talking about the bank. I'm talking about the business being financed by a traditional or conventional financing institution like a bank. So you probably have less than 3 years of personal, corporate, and financial statements. When I talk about financial statements, of course, you know, there are three primary financial statements. You have the income statement, also known as a profit and loss statement. You have your balance sheet, and you have your statement of cash flows. Now, typically, the bank is going to require your P&L, also known as an income statement, and your balance sheet, typically. I haven't been asked a lot for our statement of cash flows, although we do have them. So income statement and balance sheet are absolute minimum. Income statement is going to show you the money that's coming in and going out of the business, and the balance sheet is going to show you your liabilities, both short and long term, and the assets that the business has. Okay, so to be bankable is the absolute inverse. You got a strong business history. You've been in business for 3+ years. You're profitable, meaning you have top line revenue growth, talking about revenue, and you have bottom line growth, talking about net profitability. So just, get very familiar with the accounting terms. Make sure you can talk to your bank in terms they understand. Understand the difference between revenue and sales, revenue and expenses, costs. Being able to understand the different categories in an income statement and balance sheet are going to be key to make sure you and your bank are talking apples to apples. Okay. Making sure that your financials have been either compiled, reviewed, or audited based on your business success. If you got less than 10 million in sales, I would tell you to do a compilation or a review. More than 10 million in sales, definitely you should be doing an audit at that point annually to make sure that the financial institutions have trust in your numbers. And then you're going to need 3 years of corporate taxes, personal taxes, and financial statements. Those things are some of the things that will determine whether you're bankable or not from a corporate standpoint. Now, for my newer businesses, you may still be required to sign on behalf of the business. So the business may not be in a position where it can stand on its own. So you may be required to do a personal guarantee, even though you're getting a business loan. Just be aware of that, especially when we're talking about the conventional business methods. Now, for my government contractors, do know that a lot of your banking institutions struggle with underwriting your business when it comes from an accounts receivable perspective, but we're going to talk about some options of having you navigate this. Now, I will say this: the traditional banking institutions are getting much better than they were, in terms of providing finance for government contractors. But we're going to talk about some options that you should explore. Okay. Now that we got the bankable, unbankable conversation out the way, some of you are bankable, some of you are not today. Don't be discouraged. When I first got started, I wasn't bankable either. But I'm hoping to put this video out to kind of let you know what the bank is looking for. There may be some other things as well, but I'm going to talk about the major highlights. You can think about self-funding your business. Now, what does a self-funded business look like? This may be you basically putting up your own money. This could come from savings. This could come from investments. This can come from a 401k. Now, I'm not recommending you do take cash out your 401k in any means. So before I even jump into this, I am not giving you financial advice. Please contact your financial advisors and come up with the plan that best works for you. I'm simply telling you what I did. I am not in any way suggesting that you do what I did to bootstrap or self-fund my business when I got started. But I did cash out my 401k initially. This was after the housing crisis, 2008. I had made a significant amount of money. Of course, most of our 401ks, I work for the federal government, so it was actually called a TSP, a thrift savings plan, the federal government's version of a 401k. I did cash it out, and I did take significant penalties. Now, this was after 2008. This was actually in 2010 when I did this. My portfolio was beat and battered because we were coming off the real estate crisis of 08. So the money that I had in there was not the money I cashed out because it had been beatered and battered through the financial crisis. But do recognize this may be an option for you and your business. Now, another option, crypto. I made some money in crypto. You can, if you got a good exchange, you can take those crypto assets and you can convert them into cash so that you can finance your business. Real estate, of course, these are great assets. I do not recommend in any way that you sell your real estate holdings. However, I do want to make you aware that if you are in the process of liquidating some of those assets, we do have a real estate market correction coming. This is not an investment video, but just realize that your real estate portfolio, whether it's a HELOC or it's a sale, HELOC is a home equity line of credit. That is an option. Again, this is not financial advice. I'm just giving you some options that you can use to finance your business. Then, of course, the stock market. If you got some stocks that have performed well, those may be viable options for self-funding. Okay. But before you start asking for money, your sources of capital want to know if you have skin in the game. It is not wise to approach other people to finance your business and you have not invested in your own enterprise first. We want to see, as investors, we want to see if you have skin in the game. How much of your own money are you willing to put at risk before you pursue some of the options I'm going to talk about in this video? Next, friends, family, and fools. When you start a new business, after you've self-funded, if you have self-funded, if that's an option for you, next group of people you want to talk to are your friends, your family, and I call them fools. I don't mean that in a derogatory way. These are the people who just don't know any better. So when you talk about family members, this may be mom, dad, sister, brother, aunts, uncles. They may have some financing and they may believe in what you're doing. Now, that wasn't the case for me. I was not able to get money from friends, family, and fools. So I self-funded, and that's how we get our business started. Now, you may have friends. These are people who may not be family members, but believe in what you're doing. Maybe you've been talking about your business and they have made some strong investments or they've saved and they believe in the business. They're willing to give you a loan for the business. This is a great form of investment for some. I recognize that friends and family may not always be viable options for everyone. It definitely wasn't for me. And then you have fools. You have people who have made some money, may not be financially wise, or they could be, and they're willing to take a risk. Because I need you to understand, when you start a new business, it is risky, not only for you, but it's also risky for those who are going to finance you. So you're looking for patient capital, I call it. This is money that you borrowed today, and it may quite frankly take you a while to pay it back. And your friends, your family, and hopefully these investors who have I call patient capital, they may be able to endure with you long term for the long-term success and growth of the business. So that's an option as well. Number 3, after I self-funded, number 3 was the option that I employed the most. This is factoring. Factoring is a financial transaction that allows you to sell the asset, this is the receivable, to a third party. In exchange for that sale, you're selling your invoice at a discount. For example, I'm going to use round numbers so I can do the math in my head. Say your business is generating $100,000 a month in receivables. So you're doing the business, you're doing the work, but you can't wait 30 days to get paid. So at the point of being able to generate an invoice, you can sell it to a third party. So they'll take that $100,000 invoice and they may do a 90-10 split or 85 split, depending on if you're prime or sub. If you're prime, you'll typically see 90-10. If you're a sub, you'll see typically, and this is typical of every business is different, you'll see an 85-15. But we're going to just use the example of you're a prime, you got a 90-10 split. So you have a $100,000 invoice. The factoring company is going to give you 90% up front. That means they're going to give you $90,000, which you're going to use to keep your business moving. You're going to pay payroll and pay any other business expense to live to fight another day. The 10% is going to be held back. So once your customer pays the invoice, and that invoice is going to be paid directly to the financing institution, the factoring company, they're going to, of that 10%, they're going to deduct their fees. You'll see between a 1% to 2% fee on factoring. It's a very expensive form, not very expensive, but it's an expensive form of capital. So of that $10,000 in reserve, they're going to deduct their fees. And let's just, for our example, say it's 1%. So the remaining $9,000 will be returned to you. So that's how it works. So when you see factoring, you will see between 1% to 3% fees that are being charged by the financing institution to give you that quick upfront money at the point of invoice submission. So what typically happens is when you submit the invoice, you submit the invoice to the institution that you're doing the work for, whether that's a government agency or whether that's a prime contractor. You would typically CC the financing institution on that email. And when you CC them on the email, then you'll go through the processing with the factoring company to get those invoices paid and get the money in house. That's all I'm gonna say about that. We can go a whole video just on factoring, but this was a way that I was able to get my business and keep moving forward until we got into a position where we could get traditional or conventional financing. Now, this number 3, you can be non-bankable, meaning you're not quite ready yet to get traditional financing from the bank. This is an option for you until you get bankable. And then of course the interest rates will go down. So you're seeing 1% to 3% per month. That is an expensive form of capital. You'll see similar options once you get into a bankable situation. We'll talk about those here in a moment. Number 4, this is what most of us are familiar with. This is a revolving line of credit. Think about this as a glorified credit card, for lack of a better term, for the business. And I use that. It's not a line, it's not a credit card, but it behaves like one. So you will be giving some line of credit amount, let's just call it $1 million, and you can use that money as you need. And then of course you're gonna pay interest expenses on a monthly basis, but you can use this money when you need it. And then of course you have this open line of credit available that you can use and pay back as you need this. Like I said, this is very similar to how a credit card operates, but this is a big line of credit for your business. Now, from a small business perspective, you'll see these typically at $750,000 and below. Once they, and again, it's going to depend on the banking institution. Once they get larger, you're going to move to what I'm going to talk about next. So this is your revolving line of credit. It's a line of credit at a preset borrowing limit that can be tapped at any time. The borrower can take money in and out as needed until the limit is reached. As the money is repaid, it can be borrowed again. So for example, say you got this $1 million line of credit, you spent $900,000, you got $100,000 available. Once you pay down that balance of $900,000, more money will be available to you when you need it. So again, very similar to a credit card. A line of credit is an actual formal arrangement. It's an instrument between the financial institution, usually a bank, and a customer that establishes a maximum loan amount that the customer can borrow against. That's you. The borrower can access money from the line of credit as needed and cannot exceed the maximum amount. If you start bumping against the maximum amount, you're gonna have to go back to your banking institution and ask for a credit limit. Now, I need you to understand, These things do not happen quickly in most cases. So manage your line of credit properly. Let me go back one screen. What I do like about the factoring line, especially when you're new, it will allow you to grow rapidly. It's fairly painless to increase the line of credit or the factoring line available in factoring. That is not the case in the line of credit. So factoring is a financial transaction as well. It's a type of debtor finance. So these are loans. Now I want to say this because I didn't say this when I was on the previous slide, so I apologize for not covering this sooner. The business sells its account receivables to a third party. That third party is called a factorer or a factor at a discount. The business sometimes factors its receivable assets to meet the present and immediate needs of the business. Now, there's two types of factoring. You have non-recourse and recourse. Not to turn this into a factoring promotional video. You need to understand the difference. Non-recourse means that you walk away in the event that your customer, so that's a prime or the federal government, doesn't pay the invoice, you walk away. Now, typically, non-recourse loans have a higher interest rate because it puts more risk, more burden on the factorer. Then you have recourse-based factoring agreements. This is if they cannot collect the money from your customer, they're coming back to you to collect, and they can take liens against your assets. So you want to know if you're getting into a non-recourse or recourse factoring agreement. And the best thing, and I didn't talk about this, I apologize, but I'm covering it now. This is not based on your credit. This is based on the credit worthiness of your customer. So if you're doing business with a large prime, and I do recommend doing business with federal agencies directly or large primes. You say, why, Kurt? You want to because they want to be able, you want them to be able to pull the credit worthiness of the customer without you having to provide extra information. So when you deal with publicly traded companies, the Lockheed Martins, the SAICs, the Amazons, these publicly traded companies, their financials are available at the SEC website because these are publicly traded companies. So it's going to be a much easier sale and you're going to be able to grow. If you deal with the company that's not public and they're private, you may be asked to reach out to that company to obtain financials so that you can get funded. If you will reach out to me for my financials, I'm not going to give them to you. And most businesses, unless you have a strong relationship with executive leadership, are not going to turn their financials over to a third-party financing company that's not theirs. Of course, they're going to give the information to their banker, but you're asking them to give their financials to a third party, they're probably not going to do that. So I do recommend dealing with the large businesses if possible, and definitely the publicly traded ones. It will save you a step. I recognize that's not always possible, but I just want to kind of pre-warn you that it could cause you to do a back and forth with your customer to get the finances. Now, if you're dealing with a government agency, whether it's federal, state, or local, this is not going to be a problem. But when you start being a sub to primes, be aware of their size. And this is one of the financial implications of that. Okay, let's get back on track. Number 5, your asset-based loan. This looks very similar to a factoring line. These come from the bank, and these can go into tunes of hundreds of millions and billions of dollars for that matter. So asset-based lending is in the business of loaning money in agreement that is secured by collateral. That collateral could be your receivable. So it's not always a piece of real estate or some deposit. Now they could require a deposit, but it's asset-based loan or line of credit that's secured by inventory, accounts receivable, that's your invoices, equipment, or other property owned by the business. The asset-based lending industry serves businesses, not consumers. So you're not going to get this money if you are a consumer. This is for business. This is business lending. And it's also known as asset-based financing. It's like factoring, but it's much cheaper. There's going to be less red tape when you have an ABL line. And at this ABL is short for asset-based lending or asset-based loan, it's going to be much more streamlined than dealing with a factorer. Some of the some of the due diligence that's often required in factoring are not going to be required here because there's a certain level of credit worthiness, and typically your business is bankable. Now, banks do this, but also financial institutions do this that are not banks. So be very careful. Some of these ABLs don't always come from banks, even though banks do them. There are some companies that do this as well. I don't get credit for giving you any recommendations for the company, so just be careful and ask the right questions. Okay, last but not least, equity dilution or a partial sale. An owner may sell a portion of the business in exchange for cash and strategic relationships. This is where you're giving up a percentage of your business. So let's just say you're 100% owner. In order to sell a piece of the business, say the business is worth $1 million, and you want to sell 10% of that, then someone would give you $100,000 in exchange for 10% of the business. This lowers your ownership percentage. So now instead of owning 100%, you may own 90%. Those are just fictitious numbers. Now, I'm gonna give you a little piece of advice for my new small business owners. Never sell. This is my opinion. Never sell more than 2 to 3% of your business if possible. And if you give up more than that, make sure you're going to get something more than money in exchange. It needs to be some strategic partnerships. It needs to be a huge growth and opportunity. There needs to be something significant you're getting other than money. Do not sell your business just for money. What other strategic competitive advantage will you obtain as a result of this transaction? That's what you need to be asking yourself. Now, when you start looking at partial sales, that partial sale of the business is going to be based on EBITDA. This is earnings before interest, tax, and depreciation, or EBIT, earnings before interest and tax. And it's just talking about different levels of depth on an income statement. So you got revenue, expenses, you got gross profit margin, you got you're going to have operations expenses, taxes. So EBITDA and EBIT are talking about how low you're going on the financial statement, the income statement specifically, to determine the value, the corporate value of the organization. So I probably overly simplified that, but I do recommend that if you get here, you get you a strong business broker to help manage your sales so you can maximize the value of the organization when you start selling equity in the business. But never, 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 never sell for money only if possible. And a great example of this is Shark Tank. You see the folks come on Shark Tank, they're selling the portions of their business, and they're looking for the relationships and the value that the investor is going to provide. So you need to be doing this as well. All money is not good money. You need to make sure you're getting into the right strategic relationship and partnership for you, especially when you're selling equity. Think about when you sell equity or you bring in on an equity partner, think about it as a marriage. It's easy to get in and hard to get out. But that's all I want to share in this video. I hope these tools and tips were helpful for you. And I want you to go back and watch some other videos. Leave me a comment. Definitely subscribe, like, and let me know if this video was valuable for you. And I love reading your comments. I love getting your messages. And I use those commentary to come up with other topics that may be beneficial for my subscriber base. So thank you for tuning in. And I look forward to seeing you in future videos. And go back and watch some of my other videos. And don't forget to subscribe. Until next time.